Did you know that an HSA or a health savings account is absolutely one of the most powerful tools for retirement planning? But if you have one, there's a very good chance you're doing it wrong. Despite being one of the best retirement accounts available, 88% of account holders are making a major mistake and failing to take full advantage of its full potential to build wealth. In this video, I'll cover everything you need to know about an HSA. By the end, you'll have a full understanding of the incredible benefits it gives, the common mistakes that most people make, and some surprising tips about HSAs you may not be aware of. Don't confuse an HSA with an FSA or flexible spending account, which serves a similar purpose for certain out-of-pocket healthcare costs. FSAs often operate on a use it or lose it policy, meaning if you don't use the allocated funds for healthcare costs during the year, you forfeit them. That's kind of a dumb policy. Some employers allow up to a 20% carryover to the next year, but you certainly want to be very careful with these types of accounts so you don't lose money. On the other hand, HSAs operate with no such rigid rules. If you don't use the fund within a given year, they roll seamlessly right into the next year, and you can keep adding to your HSA over time. Let's start with the basics and why it's like an individual retirement account on steroids if done properly. With a traditional IRA, money goes in income tax free, grows income tax free, but then it's subject to income tax when we take it out in retirement. With a Roth IRA, we first pay income tax on the earnings. It grows income tax free though, and then the entire amount is income tax free in retirement. When we use an HSA as a retirement account, it's the best of both worlds. The money we contribute goes in income tax free, grows income tax free, and then when we pull it out for any qualified medical expenses in retirement, it's still income tax free. Unlike a Roth IRA, HSAs have no income limits, making it accessible to even high-income earners. However, it does come with some contribution limits. In 2023, these limits are $3,850 for single filers and $7,750 for a family. If you are over 55, you can add an additional $1,000. In 2024, the limits are set to increase. For single filers, the cap raises to $4,150, while for families, it increases to $8,300. You also have until April 15th to make contributions for the previous year. Some employers that offer HSAs at work may even help contribute to your HSA. However, it's important to remember that these employer contributions count towards the total contribution limit. The combined contributions of both you and your employer still cannot exceed the specified limits. For employees, the pre-tax HSA contributions are made directly through payroll deductions. And you not only avoid paying any income tax, but those contributions even avoid the Social Security and Medicare taxes. So you're saving an additional 7.65% in payroll taxes on top of not paying income tax. You also get to avoid state income taxes on any contributions, unless you live in California or New Jersey. Those two states still want their taxes. Let's consider a quick example. Imagine you contribute $2,000 to an HSA through your payroll deductions with no employer assistance, and you find yourself in the 22% marginal tax bracket. By doing so, you now have the full amount of $2,000 available to spend on health-related expenses, or you could invest it. If you hadn't made the contribution, you would have faced 7.65% FICA tax and the 22% income tax, leaving you with only $1,407 to cover expenses. That's an extra $593 of free money. If you set up your own HSA account and fund it with after-tax dollars from your take-home pay, you will get the income taxes paid on that amount back when you file your tax return, whether you itemize or use the standard deduction. However, in that case, you will only get the income taxes paid back on those earnings, but you don't get the FICA taxes refunded. While there are no income limits to be eligible for an HSA, there are other qualifying rules. First, you must be covered under what's called a high deductible health plan. In addition, generally, You cannot have any other type of health coverage. This includes an FSA you or your spouse are enrolled in. There is an exception to this rule. If it's a limited purpose flexible spending account or a post-deductible health flexible spending account, then you are considered eligible for an HSA alongside the FSA. But those are pretty rare, and I'll leave a definition to those in the description below. You also can't be enrolled in Medicare, and you can't be claimed as a dependent on someone else's tax return. However, if you are under 26 and still covered under your parents' health plan, but they don't claim you as a dependent, you remain eligible for the HSA. Now, what exactly is a high deductible health plan? Well, they come with lower premiums, but they have higher deductibles. To qualify for an HSA in 2023, a single filer must have a minimum deductible of $1,500 with a maximum out-of-pocket expense of $7,500. For families, the minimum deductible would be $3,000 with a maximum out-of-pocket expense of $15,000. These numbers are slightly increased for 2024. For single filers, the minimum deductible becomes $1,600 and the maximum out-of-pocket expense is $8,050. For families, these figures are just doubled. One huge perk is that you're not obligated to use the money contributed to your HSA each year. However, to truly harness the power of this account as a retirement vehicle, letting it sit in cash is not a good strategy. You'll just be losing money every year due to inflation. Unfortunately, only 12% of HSA account holders are investing their balances, which is a huge mistake if they want to take full advantage of this as a retirement account. Another huge benefit of HSAs is the absence of a time limit on the reimbursements. The receipts never expire. You can just keep collecting them. This flexibility allows you to choose when to be reimbursed from your HSA for medical expenses, even if it's years or decades later. By waiting to be reimbursed, contributions to the HSA can be invested and continue to grow tax-free. This not only enables individuals to accumulate funds for medical expenses later in life, but also opens up the possibility of using the account for general wealth building. It's important to keep receipts for all your medical expenses though, including items like sunscreen, over-the-counter medications, and other everyday things that may qualify as medical expenses. I'd recommend scanning and taking pictures of all the receipts and storing them in the cloud online, rather than relying on an HSA provider to store them for you. You don't want to be locked into any one provider anyway. I also recommend including the amount of each receipt in the file name when you are saving them. This makes it easy to locate receipts that total to the amounts you wish to withdraw when you get ready to take money out of your HSA. One effective strategy is to utilize an emergency fund to cover any out-of-pocket healthcare expenses while you let your HSA investments grow over time. Let's say you contribute $3,500 annually to an HSA and invest it in something like a low-cost ETF tracking the SP 500. Assuming an 8% return in just 20 years, that could grow into about $173,000. And any withdrawal from medical expenses doesn't affect your taxable income. Thus, it has the potential to keep you in a lower tax bracket and possibly allowing you to avoid capital gains tax and taxation on Social Security benefits. Once an HSA is established, meaning the account holder has deposited at least $1, any future health care expenses are eligible for reimbursement from the HSA as long as the account exists, even if they are no longer eligible to contribute to the HSA. For example, if a client enrolls in an HSA eligible plan while they are young and healthy, maximizing contributions and leaving the funds invested for the long-term growth, and then decides to switch to a low deductible plan later in life when maybe some health issues pop up, they should continue to track all the expenses going forward and save the receipts for future reimbursements. Now, many employer-offered HSAs don't always give you good investment options, and sometimes they come with higher fees. But there's a solution to this. HSAs come with the advantage of being fully portable. Unlike employer-based retirement accounts, HSA holders don't need to wait until they leave their company to move an HSA balance. In fact, HSAs can be transferred to a different provider even while the account holder is still participating in the employer's plan and contributing to the established account. To continue making contributions or receiving employer contributions, it's important to keep the employer-provided account open. Like IRAs, you can hold multiple HSA accounts with various providers or roll over and combine accounts. This flexibility allows you to move an HSA to a place with better investment options and reduce fees while still contributing to the employer's HSA. I want to clarify that I'm not compensated for any recommendations, but if you're looking for an HSA account with a wide range of investment choices and super low fees, consider checking out Fidelity or Lively. Both are great. Fidelity offers all of their normal investment options, and Lively allows you to open a self-directed window, giving you access to Charles Schwab and all of their full range of investments. Another perk, unlike traditional IRAs or 401k accounts, HSAs don't have any required minimum distributions. And in the unfortunate event of passing away, naming a spouse as a beneficiary of an HSA allows the surviving spouse to continue to use the account in its tax-free status for the rest of their life. But if a non-spouse beneficiary is named, an HSA is immediately payable and taxable. HSAs are not subject to probate. HSAs bypass probate and pass directly to the designated beneficiary. If you want to keep some of the HSA available for unexpected expenses or to cover part of your deductible, it's advisable not to invest that portion in stocks. You wouldn't want to be in the situation where you must withdraw the money from your investments in a year where the market might have dipped. One strategy could be to keep a few $1,000s in cash and invest the rest with the intention of letting it grow for retirement. Planning for the future here is important because you can expect plenty of healthcare expenses in retirement. According to Fidelity, a single person age 65 in 2023 made around $157,500 saved in after-tax dollars to cover healthcare expenses in retirement. For the average couple at the same age in 2023, the estimated amount is approximately $315,000. These figures highlight the importance of considering an HSA as a crucial component to your retirement saving strategy. Now let's review what qualifies as a health-related expense when using an HSA. You can't use it to cover normal health insurance premiums, but you can use it to cover health continuation coverage like a COBRA plan. You also can use it for various other areas such as vision and dental expenses, prescriptions, in-home health care, nursing home expenses, and many Medicare-related costs, including premiums for Part B, Part D, and Advantage Part C plans, as well as long-term care insurance and other Medicare expenses such as copays and deductibles. An HSA fund can be even used for over-the-counter cold and flu medications, sleep aids, allergy and sinus medications, and more. The list is long and allows for a lot of flexibility. If you withdraw money from your HSA for any reason that doesn't qualify, though, for a health-related expense, you are subject to income tax on that amount. If you are under the age of 65, there's also a hefty 20% penalty. However, if you're over 65 and use it as an unrelated health expense, you only have to pay the income tax. In that case, It essentially operates just like a traditional IRA. As you can see, HSAs are a powerful way for people to realize tax-free investment earnings while also providing a designated tax-free buffer against future healthcare costs. If you do have a high deductible health plan, this account is certainly one you want to take full advantage of. Thank you for watching. I hope you hit the like button and subscribe, and please leave some comments below.